I hate to break it to you, but if your business is profitable, it doesn't mean that you have cash flow. Does that sound confusing? In this video, I'll break down the reasons why your business can have massive amounts of profits, but be really short on cash. We'll go over 5 reasons why profit and cash flow are different. So let's cover the basics. If I was to ask you to give me a definition of what profit is, you'd likely say, hey Ali, it's pretty simple. You take your revenue, minus your expenses, and whatever left is profit. And you'd be right. However, accounting rules are kind of complicated. Whenever you look at a set of financial statements, the profit number that you're looking at is what I would call accounting profits. Okay? It's not profits in the sense that you just take your revenues minus your expenses. It's actually a slightly different number. It's what I would call accounting profits. Now you're probably asking yourself, Ali, what is accounting profits? Well, let's dive into what accounting profits are. So if you're wondering what accounting profits are, essentially what accounting rules require you to do as a business owner is record all of your revenues and expenses using a method called accrual accounting. Now, if you're confused about what accrual accounting is, don't be worried. I'll create a separate video to go over what accrual accounting exactly is. Now, importantly, accrual accounting does not give a damn about cash flow. Accrual accounting simply tells you how to record revenues and expenses in a manner that makes economic sense. And that's why you always have these differences between profit and cash flow, because the way profit is recognized on your profit and loss statement or income statement is based on a set of accounting rules which are somewhat arbitrary from time to time and don't necessarily match how cash comes into your business. Alright, so now we'll cover 5 reasons why profit and cash flow are different. Number 1, buying capital assets. Let's say you're a factory owner and you'd like to buy a delivery truck, and that truck costs you $50,000. Now for cash flow purposes, pretty simple transaction. If you have to buy a truck and you gotta pay a dealer $50,000, as soon as you pay the dealer 50 grand, you're like, that's it. For cash flow purposes, that money went out the door and I don't have it anymore. I paid that person 50 grand. It's pretty simple. However, for profit purposes, this is where it gets a little tricky. What you have to do for for the purposes of calculating profits, accounting rules basically stipulate that you take that $50,000 for the truck and capitalize it on your balance sheet. You can't expense it right away. What does that exactly mean, capitalizing it? It means that accounting rules require you to basically take that particular truck, put it on your balance sheet, and expense it into the income statement, so for profits over time. Let's say accounting rules state that you have to expense this truck over 5 years. So what you would do is take the value of that entire truck, $50,000, divided by 5 years, so that's $10,000. You would expense that price in increments of $10,000 every year for 5 years until you've expensed the full $50,000. So you can tell already how there will be a bit of a mismatch between how profits and cash flow are calculated. Number 2, inventory. Now, if you're a business owner that manages a lot of inventory, like you have an e-commerce store or a Shopify store, congratulations. You're going to be dealing with mismatches between profit and cash flow all the time. And here's why. For cash flow purposes, if you're buying some inventory, let's say you buy $100,000 worth of inventory, you pay your supplier $100,000 and that cash flow is gone. It's out the door. However, for inventory purposes, again, it gets slightly complicated. It's actually very similar to the example I just covered for the truck, whereby you would take all of the inventory that you've bought, that $100,000, and what you would do is essentially take it and capitalize it on your balance sheet. So park it on your balance sheet, and what you would do is, as you make sales to your customers, you would gradually expense that inventory as you're making sales to your customers. So as you can probably tell, there will be differences between cash flow and inventory. For cash flow purposes, you've expensed the entire 100 grand. However, for profit purposes, what you're doing is you're gradually taking those expenses over time as you sell the inventory to your customers. So naturally, profit and cash flow are always going to be different. Number 3, accounts receivable. Accounts receivable are basically a lot of the invoices that you've sent to your customers that your customers haven't paid yet. So let's go over a very simple example. Let's say you sell something to your customer worth $100 in December 2021. Let's say they have 30 days to pay that bill. They can pay for that amount, that item, in January of 2022. When you're doing your books for the year ended December 31st, 2021, what you will record is accounting rules will tell you that you need to record that $100 sale in December 2021. Even though you didn't actually get the money into the company, because you invoiced your customer, accounting rules stipulate that that is a sale that has been made already. And from an economic perspective, that money has come into the business already. So what you would do for profit purposes is record that sale as revenue. So your profit would basically increase by $100. However, for cash flow purposes, in December, you didn't get the money. You're going to get the money in January. So you can tell, again, there will be a difference between what you report for profits and what cash flows are going to look like. There will be a $100 mismatch between the two. And until January actually happens, that's when your cash flow will actually get that $100 that your business has already recorded as profit. Number 4, deferred revenue. If you're the type of business that sells subscriptions, let's say you sell a year's worth of a subscription to your customer for $120. So $10 a month over 12 months, $120. The customer pays for that in January of 2022. When that money comes into your business for cash flow purposes, you get that $120 right away. So your cash flow is up by $120. However, for profit purposes, you can't take that $120 and recognize it as revenue right away. What accounting rules require you to do is basically take that money, the $120, and capitalize it on your balance sheet as something called deferred revenue. And eventually, what accounting rules state is that as the months go by over the entire year, you can take $10 increments, so 120 divided by 12 months, $10 increments every month. And that's how you would eventually recognize the money that you got up front into your profits. So as you can probably tell, for month number 1, there'll be a complete mismatch between what your cash flow number shows and what your profit number shows. Your cash flow number will show that you got $120 into the business, and your profit number is going to show just $10, just 1 month's worth of subscription that you've actually earned. So the difference between the two will be $110. So as you can tell, in this particular situation as well, cash flow and profits will be different due to a timing difference. All right, and number 5, accounts payable. Accounts payable are essentially invoices that you receive from your suppliers that you haven't paid yet. So let's say it's the end of the year again. It's December 31st, 2021. You got an invoice from a supplier worth $100. When that invoice comes into your business, accounting rules require you to expense that amount right away. Because that expense occurred in December of 2021 and you received the invoice from your supplier, you're required to book that expense. But let's say you actually pay that invoice in January of 2022, so the cash flow actually goes out next year. You will have a mismatch again between what your profit number will show and what your cash flow will show. In this particular situation, your profit number will be reduced by the $100 bill that you got. Your cash flow number will have no impact because no money has actually left the door. The money will only go out when you actually pay that bill in January of 2022. Thank you for watching, and we'll see you in the next video.